Management Academy live trading room, live streaming from TikToker. We got some economic numbers that I want to share with you this morning regarding durable goods, and we'll see where we are with relation to the market here. The durable goods were down unexpectedly, down to one, I believe, minus 1.1% from an expected 0.4%. And a big part of that is confirming pretty much what we've been saying here for the last few weeks, is that the supply chain has been broken, and we have difficulty finding certain products. And so it doesn't bode well, for the interest rate rise that we saw on the 10-year. In fact, my opinion is that they allowed the 10-year note to go up in order for them to bring it down again. We saw almost the rates go from 0.80% to 0.75%, more than double that in a very short period of time. And the market reasoning behind that was that the 10-year note was beginning to anticipate an inflationary risk being built into the market as a consequence of all this stimulus. So I think in the long term, that's going to play a part, and it is playing a part in terms of where the market goes long term. But short term, obviously, the sentiment that rates were going to go back up again, and that they were going to be bearish for the gold market, I believe, is being put to sleep, so to speak, after this economic indicators came out this morning. Because what this means is basically that the pressure is to maintain rates low. And rates are going down. The 10-year note is down to about 1.64. It's down about 10 basis points already from the high 1.75. And so now that we got this report, we're taking a look at the obviously the metals markets reacting bullishly to this report. Because it is bullish, the sentiment is bearish in the metals, obviously, but the interest rate picture keeps building up to be very positive and supportive for gold long term. So fundamentally, the durable goods number showing a slowdown is really a sign that the Feds are going to continue to maintain rates pretty much down and possibly go even negative, depending upon how deep this recession becomes. Or if we are going to, as we get back into the economy, get back into some kind of velocity of money that would represent people chasing fewer goods, obviously, that do not exist, or we have a problem with supply. So we're looking at this scenario here this morning to be supportive of what we've been expecting here, which is that the gold market is completing a correction, is completing this correction, and I believe that this week is an extremely important week where the VCPMI indicators are expecting a reversion to unfold. So when we take a look at where the markets are right now, and we get this continuous fundamental chatter that keeps coming in that is very supportive to the market. In fact, some of the comments Powell made and Janet Yellen made are the economy is in need of more stimulus, more stimulus, more stimulus. The truth of the matter is that I think that was the best thing the Feds did last March, was to inject huge capital huge amounts of capital into the market. And if we, I think, put it all together, the numbers are staggering. They're beyond 10% of GDP. When you go back to September of 2019, when we began to see some weaknesses in the repo market, and the Feds begin to inject $120 billion a month, I believe, in terms of stimulus. And that really was quantitative easing that I consider to be any amount of money that's printed, obviously, is in some form, whether it's quantitative easing or the stimulus is really chipping away at the U.S. dollar, the integrity of the U.S. dollar, because we're leveraging our economy. I think now maybe we're at 15% when you take into account all this stimulus, all this money that's been printed. So the reality is that if you look at the numbers, they're staggering numbers that I think, since 2008, in order to keep a $20 trillion economy going, we've spent more than $30 trillion, which has gotten into this huge debt that we're in right now. And the danger that I see here is that if interest rates do rise, whether it be by market forces, vigilantes, bond ratings in the U.S. at some point, are going to snap any growth. It's going to snap any positive margin that we have seen, if we have seen any, in our economy, not to mention a global economy. One of the things that are beginning to kind of appear once again is the possibility that the Eurozone may be going into another lockdown. Germany, I believe, is in a partial lockdown. Italy, the variances or variants of this pandemic are beginning to, I think, to take a real toll on the world economy, and that is going to translate. How much is that going to affect our economy? This virus is out of control, and I think the whole world is dealing with this incredible pandemic that seems to be causing massive dislocations just across the board. So we're not out of the woods yet, and I think we're building this momentum underneath the precious metals markets that basically is an economic tsunami that's building, I believe. We haven't seen yet the reaction of gold and silver in terms of its economic leadership. It's been manipulated forcefully in terms of price discovery, obviously by massive short sellers, convenient to keep the integrity of gold as a precious metals away from the public, which is the biggest mistake that we're going to find they have made. And obviously, it's competing with the dollar. They don't want investors to compete with the U.S. dollar in anything, and that even goes for Bitcoin or virtual currencies. Let's take a look at where we are here today. In terms of the gold market, the chart on the left is going to give us the numbers for today, which is basically the average price is 1730. And we've come down, as you can see, to the weekly buy one level that we've been trading this whole week pretty much at 1722. We tried it several times at 8:30 a.m. yesterday. The low was 1722.70. At 10:30 a.m., 1722.90, and at 6 p.m. at 1722.30. This was the lowest number that we saw here for the weekly buy trigger at 1722, and 1722.30 was close enough to complete the pattern. This is where you want to use about a 10% margin of error in here in terms of executing this this system here, that you as a self-directed individual, you want to take a certain control. Nothing is a perfect science. So, if the market doesn't come down exactly and crosses the number, use a 10% margin of error, because if you make 80% of this range between, let's say 18 or 30, you're looking at $12, and 80% of $12 is a pretty good profit factor for you if you're looking for a trade. One of the things that the VCPMI does, coming back here to those that are just joining me here, and by the way, I want to thank everybody for all the comments that you make in here, and please continue to ask any questions or get in contact with a Ticket Talker here. We're having a special meeting this Saturday, particularly to take a look at the 9-year cycle in the silver market. And we are opening that for those that are interested, because I think we're beginning to see some really, really interesting developments here that are being identified by the AI behind the variable changing price momentum indicator. So coming back here, the market rallied from the buy one level, obviously, into the target zone, the daily target zone, and has not yet completed the target weekly zone, which is 1738. So right now we have a weekly buy signal from 1722. Your protective level is 1722. Depending upon how you manage your position with regards to multiples, you can take some out at the average of 1730 and manage the balance. If we close above 1730 on the daily average, it brings in the 1738 daily target, which is completely harmonically aligned with the weekly 1738. This is what you call a perfect harmonic alignment. And this is like a magnet that has basically a mathematical probability built into this structure daily and weekly, that is telling us that there's a very high probability that we're going to be testing that 1738. So that's the target that we're running on our long positions, and if we are able to close above 1738, now you're looking at an acceleration towards that 1750 to 1763 area on the weekly, and even even 1776. So the pivot point, critical level to challenge and overcome, you might say, the selling pressure is 1738. So far, we're trading around the average, and we continue to say when you trade around the average, it's a 50-50 standard deviation. So you want to, as a trader, using this methodology, wait for the highest probability trades, which is that the market will go above the average at the extreme above or sell one, or the extreme below or buy one. The buy one or sell one level are a 50-90 standard deviation to the mean, and they are activated about 80% of the time when it comes down here, the majority of the time. Whenever the market comes to levels, the B2 levels, and ideally, daily, weekly, and monthly, harmonically, it's a pretty strong sign that is where the value zone is, which has been calculated by the algorithm. So we're looking at the value zone anywhere down to 1722, 1718, 1711, all the way down to 1701. And the AI tells you that use these levels, if activated, as a correction to add to the long side. That's the intelligence behind the signal, the AI right now. So how do you apply? Obviously, it's a question of your profile as a self-directed individual, how you want to position your portfolio if you are able to get this kind of intelligence. We're showing you in futures, in the futures contract here, how we identify the extreme levels of the supply and demand above or below the mean. The silver chart on the right is showing that 2536 is the daily average price and coincides with the weekly buy two level. So what does this mean? Well, going back to the harmonic relationship again, you're looking at the daily average of 2536 harmonically aligned with the 2536 by 2 weekly level. So if we take a look at the daily, trading below the average obviously is in a bearish trend momentum. And it's neutral because it's trading around the average. The trend momentum was activated bearishly here on the close below 2536 at about 7:30 a.m. yesterday, and not quite was able to come down below 2502. Found the buyers that took all this selling pressure out of the market, bought all the supplies, and the market reverted right back up to that average daily of 2536. Now, what you're looking at here is the market trading on the average daily of 2536 and hovering around the buy 2 weekly level, which you're looking at an extremely strong signal if the market triggers a buy signal by closing above 25.36. You're looking at a 95% probability that the market is going to revert back to the mean of 26.29. And it activates not only the average price, which is the weekly average of 26.29, but it activates the levels above. On the weekly, the next level is 25.85. So we are talking about a potential dollar in silver just from the extreme below the weekly. And if we're looking at the weekly so far number from the extreme below to the extreme above the sell two, you're looking at about a $2 range, which is possible for silver for this week. These are the numbers that have been activated this week. It doesn't guarantee that it will go there, but these are the numbers that the probability model is telling us. And the market synergy or action into these numbers is what activates the AI. What the AI tells you is that if we close above 25.36, not only we're activating a very strong weekly signal, but we're activating as well a daily bullish price trend momentum. And automatically it activates also the daily targets in between of 25.66 to 26.22. And that was written in C++, easy language. So this is how I personally identify the entry points, exit points, my stops, in taking a look at the market from a mathematical probability, not a fundamental point of view. Although I use the fundamentals because they are the laying ground in precious metals, the economic fundamentals that we're dealing with in the monetary system and in the world economy. Gold plays a major part, always has been and will be a major player. When we come back to the basics, we're going to realize that real money is gold and silver. And silver in particular, I believe, is getting set for a very, very potentially explosive rally that could begin any time. And we're looking at possibly this week, by the end of this week, for this energy to complete the testing period, you might say, that it's doing at these levels here that are in blue, as you can see. And the lower that the price comes down into this algorithms in blue, the higher the probability that we're going to see a reversion or potentially a bottom in the market. So the question is, when is the bottom going to be made this week? And I think we're looking at 25.02, the low being today, 25.02. And it could come down to as low as 24. 2480, 2490 to activate the daily. But so far, we've come down to this area of support, supported by this Fibonacci trend lines. You see here. Let me see if I can change the appearance here for a minute to get a better perspective on this chart here. Here, there's a little cluster that we're coming into that seems to be holding this support and validating the energy that we're looking at. That basically the algorithm is saying, listen, we're in blue. Expect buyers to come in, expect green bars from here. So my confidence level is pretty cool as far as buying in here. I'm not afraid of selling because I think, again, based on this indicator, is telling us that even though the market may come down as low as 24.49, is in a buy zone. And that's where you want to begin to apply this intelligence. And obviously, how you apply it is a question, again, of your profile, whether you do futures, whether you do options, whether you do securities, whether you do stocks, ETFs, or how you want to cook this enchilada, so to speak, according to your profile. So what I'm showing you here is how I'm trading this for day trades and how I'm using it to position myself in what I believe is going to be a pretty exciting market here in the not too distant future. If you are interested in pretty much the work that I do, feel free to go to my website, Equity Management Academy, and you can see the track record. And we're fairly about unchanged so far from last year, and but you can see basically everything that I'm doing live streaming here in TikToker, and we have recorded over 200 and 50 hours of real trading in which we have executed this information, and we are up about 283%. We have net profit last year of about over 700,000. And as of I think very recently, this is updated, and you can see here pretty much the inventory in all the trades that I do, that I call out, and pretty much I am trading this indicator here for the benefit of my account here at the Equity Management Academy. I make a point of teaching and coaching on a simulated platform so that you individual traders can make a choice whether you simulate or whether you follow it in real time. Let me share this with you, and I'll be back here in a little bit.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze
Bear with me here. It's a bit slow here.
analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our variable changing price momentum indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.
Thank you for listening to that. Coming back to the market here, pretty quiet as we are looking for the direction from the average price on the daily here. Pretty quiet as we are looking for the direction from the average price on the daily here. Pretty quiet as the silver and gold here, pretty quiet. The gold is trading around the average of 1730, and silver is trading below the daily average and also below the weekly by to a level of 2536. So we're gonna expect that because we are in a blue area, as you see here in the silver market, that we're going to be looking to trade above 2536. So let's just watch the market here and see where it wants to go here. But we're kind of neutral here on the gold, and we're looking for a buy trigger in silver at 2536. Pretty quiet across the board. Equities are fairly quiet, the mini S&P as well. The dollar index is activating a sell signal from that sell one level, as you can see on the chart, of about 92.59. So the 10-year note, the yield is fairly quiet, and it's down to about 163.80. So it's about unchanged, and that's what I believe is given the gold market and silver the support that we need. So we're looking pretty friendly here for gold and silver as the day progresses here. Continue to hold your longs, and expect that as we progress here throughout the day, we should be coming out of this area of support. I think we're going to begin to see some of the economic indicators slowing down, actually. Durable goods was just one of them. But, on the other hand, we're looking at the CPI. If you include food and energy at record levels again, breaking out, which is inflationary. So we're getting a kind of a mixed picture from this number that would be considered stagflation in some sense. But we are trying to, again, identify that model appropriate for the current economic situation, the current economic model that we're dealing with right now, which in the old physical economy, it collapsed basically. And, it's trying to come back and put itself together with this new virtual economy that we have seen expand and increase and grow since March of last year. We have moved into a completely virtual economy, a virtual world, and technology is going to play a major big part in all of this, as it has. But I think this pandemic basically accelerated that process even more. And it's forcing us pretty much, whether we like it or not, to recalibrate and integrate this new economy into our lives. And the stock market keeps on ticking. 39.11, we're on the way to 4,000. Amazing. But that's part of the virtual economy that we're talking about. That is essentially what has supported the markets from collapsing here since last year. Pretty quiet here. Just continue to monitor this. I want to share with you here a podcast that we just posted on March 21st here on our website. Good morning, everybody. This is Patrick MontesDeOca with the weekend podcast for March 21st, 2021. The 10-year note is rocket fuel for gold. This report was published in Seeking Alpha in the Associated Press on March 17th, 2021. Summary. The 10-year bond is rising in yield, which is putting some short-term pressure on the market. We expect, based on the economic situation and past Fed comments, they're probably not going to do anything. Rising interest rates may be bullish for metals. We're just beginning to see the damage caused by the pandemic to the supply chains. Prepare for shortages as more money chases fewer goods, given disruptions to the supply chain. Looking for a portfolio of ideas like this one, members of Mean Reversion Trading get exclusive access to a model portfolio by going to Seeking Alpha and clicking on Marketplace. We use our proprietary variable changing price momentum indicator, VCPMI, to analyze about 80 markets. To show how it works, we tend to focus on gold, silver, the E-mini, and Bitcoin. We expect, based on the economic situation and past Fed comments, they're probably not going to do anything. They will leave interest rates as they are and take the chance that inflation is not going to accelerate and put more pressure on the 10-year note to rise in yield. At the same time, the bond market is expecting some inflation. The metals markets appear to be hurt by such expectations, even though that expectation may be incorrect. Rising interest rates may be bullish for metals. In the 1970s, the US dollar went off the gold standard and inflation rose steadily through 1981, hitting 15%. At the same time, gold rose in price from about $135 to over $800 an ounce. We're probably not going to see 15% interest rates again. Rates are at near zero, and we have a historic level of debt, nearing 30 trillion, and continues to explode. And we have never been in such a situation before. Savings are high and people are getting free money from the government short term. The government does need to supply stimulus. But long term, such printing of money is inflationary, and that's beginning to show up in the 10-year yield. The system is flooded with liquidity, which is why it has not collapsed. But it remains to be seen who's going to pay for all of this stimulus and debt. It certainly won't be the wealthy or the elite. There will be rising taxes. Prepare for higher taxes. Prepare for shortages as more money chases fewer goods, given disruptions to the supply chains. We have a looming shortages in physical gold and silver. We're just beginning to see the damage caused by the pandemic to supply chains. To take advantage of the situation, the key is the more money that is printed, the less purchasing power the US dollar will have in the future. The risk in the bond market is also increases greatly, especially if interest rates rise. If interest rates rise, then the entire economy is at risk of major defaults on loans. To control the rise of interest rates, the Fed will begin to talk about yield curve control. Globally, governments cannot allow interest rates to get out of hand, or the entire global economy will collapse. What are the alternatives for your money if the US dollar and other currencies are losing value, especially if inflation increases? You can take a gamble on Bitcoin on the belief that it may be the currency of the future, or you can buy fine or virtual art if you have millions to invest. Or you can look at an asset that has been valued for thousands of years, gold and silver. Precious metals have been money for centuries. Most people do not realize that we are dealing with fiat currencies and they are losing value rapidly. In the 1980s, Mexico defaulted on their U.S. loans. The Mexicans allowed the peso to explode, and they went off into hyperinflation. The peso went from 16 pesos to the dollar into thousands to the dollar. They've had to devalue their currency several times through the process. Argentina, Brazil, and other countries have adopted similar policies when faced with massive debt. There's a very high chance that we could get yield curve control. If the Fed does that, it will be an explosive scenario for precious metals, especially silver. Investors will need to turn all that fiat currency into real money, gold and silver. We have yet to see the giant awakening in the precious metals markets. And when it goes, there are going to be few people in it, but there will be a lot of people chasing it. People will realize that gold and silver are real money.
Thank you.
I wanted to share that report here that kind of fits into the exact scenario that unfolded just before the announcement here of the Fed. So coming back here to the market, we are trading around the average here, 1730, again in gold. And silver, I am looking for the market to run up about 25.36 for me to basically get on the long side of the market. Let me take a look at Bitcoin here. The buy one level is 44.22 for the day. The buy two level is 45.51. And the market seems to be hovering around that 40, I'm sorry, it's 45.51. The daily average is 47.30. It's come down quite a bit. $47.30 is the daily average, and 48.59 is the sell one level daily. And then we can take a look at where the market is in relation to these numbers here for today. And 50.38 is the sell to level. Okay, so what we're looking at here is the market coming down below the daily average of 47.30 and made a low of 45.99, not quite coming down into that buy one level daily, but reverting right off the average and into the red zone. It met the first target of 48.57, reverted right back up, and we're in a bit of a corrective pattern once again from the daily level of 48.57. And if we close below 48.10, it's going to activate a weekly short trigger. And what it identifies here is that above 48.50 all the way up, you're looking at resistance. And distribution of supply. And the market can still run through that, take out that supply, and obviously go to higher levels, which is what will change the pattern here. The daily signal has come down pretty much right into a major area of support, as you see, as well as the Fibonacci trend lines are supporting. So looks like the market wants to enter into this testing area of supply again. And if we get through 53.11, then we're going to be challenging the highs of 58. This is the daily gold chart, and we're into a major area again of support, Fibonacci trendline support. And right after this breakout from the low of 1673 to the high that we saw at 1754, which was almost $100. It's amazing. In just a matter of days, we've came back to test the support below and are finding buyers at these levels here. And I think the path of least resistance from these levels after testing that 1660 right into a buy one level weekly, you can see the reversion unfolding and finding buyers down here, which is what the AI suggests and recommends when the price is in blue. We have just updated the latest version of our mean reversion book, which is basically sharing with you the components of the VCPMI and pretty much how it works. So if you're interested in finding out a little more about this, please reach out to us or go to my website and fill out a contact sheet, or we'll be more than glad to send you the book. Also, if you want access to some of the intelligence that we use, please reach out to my profile here in TikTok and take a look at the different programs that we offer, which is basically how we apply the VCPMI for the gold, the silver markets, primarily, and the mini S&P and Bitcoin, which are the markets that I focus and concentrate. But it's a universal algorithm that we track over 80 markets. So thank you once again for reaching out to me and all the positive comments that you make in here. And I hope that when you come here, you're getting every day to become a better trader. It's my mission, my sincere mission. Have a great day, and I'll talk to you next time. Take care.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks.